Yes, hello to everybody. My name is Norbert Kellner. Maybe this is so far from my side.
Great, Mike.
Yeah, Mike Danilewski, partner here at Bryan Cave. So welcome to all of you. So it's the first time that we are able to host that. I'm partner here in the Restructuring and Solvency Group, mainly dealing with real estate restructurings, which is the flavor of the day currently. Our clients are mainly financial institutions, funds, and insurance companies.
Yes, my name's Oliver Platt, not the actor, me. I'm a managing partner with Asida Advisors. We are a fully integrated real estate debt advisory platform. Our clients include Nexum Debt Potential Fund in Luxembourg, but also houses like yours. We work a lot with Davidson Kempner on distressed debt transactions in Germany, and also special situations in real estate. We also advise mid-sized banks or financial institutions, and also on the other side of the whole thing, the sponsors which are in trouble, and we try to find solutions with the sponsors and new capital.
Let's start with you, maybe Norbert, just in terms of, I guess, where we are in the market at the moment, and then we'll pick up a little bit on the outlook, because for sure there's been, quite a few changes since we last focused on the debt side.
Yeah, sure. I guess no one is surprised about the statement that we are in interesting times. I guess we are all at the minute in this what I call transition phase between a very, very lovely 10, 12 years positive cycle upwards, and now an impact where I guess all of us were saying the 2 years before, yes, it will happen one day, but I guess no one was really expecting it in such a hefty way. And what is the situation around Berlin Hyp? We are, of course, in 2023, almost half of the year done, in a situation that the deal flow is surprisingly low. So we see that a lot of our customers are just need to recalculate their investments. They need to recalculate when they are developers, for example, if they can just continue with planned projects. So overall, the number of transactions we can really pitch for is limited. And at the same time, that has an impact, of course, on our loan book, because a colleague of mine recently said, the extensions are the new businesses. So we are all a bit, focusing on our core clients. We have to make sure that what's going on is done in a proper way. And because of this, I wouldn't call it standstill, but low level of deal flow, of course, we are not getting that many prepayments. So we need to make sure that this is going on in a proper way. And all of this in combination with so many very good years where we could grow our portfolio over the past 7-8 years, our capacities are limited. Let's face it, right? So we can't really go out and offer that much as we did last year or the years before. And that all has a huge impact. And I think this is something which we can almost all see, where we have to maybe wait. We come back, I guess, to this point a bit later, or for how long. But for at the minimum, I would say, for the time being, we have to cope with this tricky situation after such a longer time.
Okay, good. And interestingly, we've got very different perspectives from slightly different areas. So it'd be good. Let's just start with you, Anders. I mean, what's your take on it at the moment? And then I'll also pick up with you, Mike and Oliver, as well.
I would echo what Norbert says. There's been very muted transaction activity, very little buying and selling. I think what we've seen is transaction volumes are at near cycle lows, and they're still dominated by equity buyers. Meaning that levered buyers are all but on the sidelines. So no surprise that investors are approaching banks like Berlin Hyp a lot less. I think combination of reasons. One, sponsors just unwilling to take hits as the dust settles on the market. We've seen a spike in rates, and I think European banks are particularly accommodating. When we compare this to the US, where we've seen much more immediate value destruction, it typically takes a lot longer for that to flush through the markets in Europe. I think what we're seeing is where we're seeing the pockets of stress first. It's far more a function of asset selection criteria and specific sectors. So within that, we've seen the pain through the retail sector. We're actually seeing green shoots in that sector, but we're now beginning to see the pain and value destruction in the office sector. So I think we're really at the beginning of the story there. And then I think across the board, particularly in Germany, as we see higher rates trickle through the system, we're going to see varied impacts per sector.
Okay, interesting. I'll pick up that point around office as well, because particularly in the US as well, a huge, massive destruction there in terms of the office at the moment, in terms of the people's perception of it. Oliver, what's your take on it? Obviously, interesting, Anders is saying there that the market comes through in a much slower way versus the US, and even plausibly a little bit versus the UK versus continental Europe.
Yes. I come from the other side of the equation, like not Norbert being a bank and having a transaction defined as lending. My clients look more into NPL transactions, and there we actually see some movement in the market. I see some faces which I saw yesterday at the NPL forum in Frankfurt, and from my point of view, there are two elephants in the room, and no one wants to talk about it. The banks, the senior lenders secured by senior land charges, they still feel very comfortable and secured. They only have an NPL debt ratio of 1.85%, which is very low. But we have the alternative debt sector, which is currently absolutely in trouble. And this leads to the other elephant in the room, because from my point of view, in hindsight, inaccurate lending values of properties, they led to loose lending. And this is now the problem. All the mess lenders, they are underwater if they don't have a personal guarantee from the sponsor. And if they have one, it might not be bankruptcy remote. So we see lots of transactions in that area from the alternative debt providers selling off loans to a discount, for a discount. And I expect also some senior lenders to follow soon. And just to give you an example, we had a transaction last year where we had a loan in A city, B location, and we negotiated a 25% haircut with the senior lender. We went back to our investors, someone like your house, and they said, 25%, that's not even close to the value we see. So we went back to the bank and said, guys, I see you think it's very generous to grant us 25% haircut, which it might be from your point of view, but my investors, they want something like 30 to 40 to really hit the actual lending value, property value. And as soon, and this is my thesis, as soon as we have realistic values in the market and there was some devaluation, we will see more transactions also from the senior lenders, which are also under some pressure because they now realize, especially the mid-sized banks, that the NPL backstop will hit soon.
And are you seeing a kind of increase in, I guess, activity from that point of view, Mike?
Yeah, absolutely. So what Oliver said is absolutely correct. And well, as a restructuring lawyer, it was exactly the time we have waited for. I have to admit, it's a good story for us. But since June 2022, the team is completely fully booked, more or less. So what we are seeing is what we actually, as Oliver rightly said, The prices. I think the distinction between the price expectation and the market, if you are talking about NPLs, is not hit yet. So, and what is the reason for that? Well, you use the term, which is the reason for that. You use the term standstill, and exactly that is what's happening currently with the senior lenders. The only term they know is in these crisis situations, oh, standstill, please. Yeah. So forbearance measures. We don't do anything. What is probably also sensible, yeah, to be honest, because looking into the structure, how to restructure a German real estate financing, it may be very sensible to avoid things like insolvencies. We come to that a bit later. But the standstill reason the standstill is the reason for the fact that banks are not provisioning enough at the current status. Yeah? So we had a discussion last week with a senior bank where we discussed further measures above the standstill, and then the direct answer was, "Oh, if we do that, we have to provision further what we don't want," and they are still evaluating on a portfolio level to which extent they are able to do that. I think this is my opinion. So, in the moment, from a portfolio perspective, not single asset but portfolio perspective, I think the banks are still considering how to deal with these situations in the correct way, and that's the reason we have not yet reached the price. We have not reached or bridged the gap.
Absolutely, and on forbearance measures, I mean, banks like Norbert's or Hellerbar, they know how to deal with the NPL backstop. But when we talk to smaller banks, and we tell them, guys, forbearance measures, they are a real threat to your common equity tier 1 capital. Because if you don't have any solutions for your loans which are by the book NPLs, so 90 days due, etc., then you have for unsecured loans, you have to provide a solution after 2 years, and for secured, you have to provide a solution for 7 years. So still they feel like very secure, 7 years, 2 years, we have enough time, but they have to find solutions. They either have to build up new workout teams or they have to sell it. But they have to deal with it, and they realize that now, and that will really bring new deals to the market. Not the big billion deals we saw in the early 2000s, but more or less deals with one loan, 4 properties, 80 to 100 million loan valuation or value to sell.
So really, the smaller players, in a way, are going to have more of a problem. And I mean, is that? Do you think there's a bit of a skill gap somewhere, Norbert, as well? Plainly, Berlin Hyp, probably, large enough to be able to deal with these, as Oliver says. But do you think there's this kind of skill gap in the market? Because most people haven't really been looking at, let's say outside distressed shopping centres or whatever it might be. Nobody's been really looking at that over the past 10 years, in essence.
I mean, I wouldn't say that there's a skill gap overall, let's say, or in general, but of course you have to keep in mind that we have, again, come back to this very long positive cycle, a long time where we haven't seen these kind of situations, right? And we discussed it a bit briefly before we started here, that, I mean, look at some of the mess lenders, look at some of the smaller players with younger teams. They are professional, experienced, but they haven't seen such crisis. They haven't coped with these crises. And honestly, they don't have the team up, what Oliver said. And in that regard, of course, that will be much more difficult for them to make here the right decisions and to oversee it. I mean, one point is, of course, what Oliver mentioned, I would like to add a little bit on that. I think it's a good point that we are not too aggressively acting here at the minute, right? I mean, no one is helped here when we started reevaluate everything dramatically with substantial new, let's say, levels, because we couldn't cope with it that well. The smaller players, the mezzanine lenders could cope with it. And let's face it, also the equity investors are not interested when they hold assets, because otherwise they will infect their portfolios with a huge, let's say, impact. So I think, again, it's good that we have, and I mentioned that a few days in another meeting, it's good to see that so far people are professional enough to keep calm, to negotiate on all sides, And my hope is a bit that we continue with that, even if I totally agree we will see hits, no doubt, in every portfolio.
If I may just echo that, there's one situation. What you currently can see is yeah, everyone is professionally handling these situations to the extent possible. What you can also see is the the complexity of certain real estate investments and real estate lending situations is just breathtaking sometimes. Yeah? There are structures out there, they are so over-engineered in a way that you had the impression they wanted to win the Nobel Prize. Yeah? So if you're now looking to restructure that, this is an animal which is really, and I know, Anders, you are also looking into these situations sometimes, you cannot even solve the first question: who is now in the senior, who is senior tier 1, who is senior tier 2, who has the loans, who is in the notes, who is the mess really 1 or mess 2, and where is the security over there? Yeah? So is the security in the buildings sometimes, or the projects are then separated into certain buildings where everyone gets its own security. To cut a long story short, this puts a bit of complexity into the whole restructuring arena. And these are not only the really large ones, you are also seeing this in very small real estate financings, where you have 3 or 4 level of debt, equity, security all over the place. No one really knows how to solve that, which is also one of the reasons it is so slow, I have the impression, and is so professionally tried to handle, because everyone knows it's like in a Mikado game. If you're tearing one of the first 6, then the whole structure crumbles. And I think this is also one of the things we all have to look into, and which we are currently seeing, that the most complex issues currently are also on the market.
Maybe just to echo that, and curious to hear Oliver's view, I think for investors like us, this is where the opportunity is. The opportunity is not yet, and I don't think it will be for quite some time, buying assets at distressed prices, because again, that's going to take quite some time to flush through the system. Maybe a couple of live examples. We're getting calls from banks like, not necessarily Berlin Hip, but situations where the loan LTV went from, say, 50 to 80%. Perhaps the sponsor's willing to put in a equity contribution, but not sufficient to get it down to 50%. They'll call investors like us to fill that funding gap. And banks are telling us that even after a modest equity contribution, they would need to increase loan margin from anywhere from, say, 2% to 7% in order for that RWA to, call it, tread water. So in order for them to earn the same return, they'd have to increase the margin by 3 or 4 times. Now, they're not going to do that on their clients. So they'll call investors like us and say, can you fill this funding gap? They're willing to pay our cost of capital, say mid-teens, in order to steady the ship. But I think what's interesting there is also they're probably not willing to pull the plug because they know how value destructive it would be. And there may still be equity in the loan, but the RWA is just completely off. So something needs to happen. But I think it's less likely this time around that we're going to see a mass of NPLs, because it just doesn't look like it did 5-6 years ago. There's still room to play with. And if you're willing to go into these complex situations and you can think, if you can get through that complexity, I think there are ways, or there's more ways for it to be resolved consensually.
And just to add on that, we're just looking at a few situations where pulling the plug would be the absolute wrong decision, because, and this is something we learned the hard way back in the day. I was head of legal with Hudson Advisors. We bought the first big NPL transactions in the early 2000s, HAE and Commerzbank, etc. And what we did back then, we really started with starting a foreclosure proceeding on every loan and just cracking the whip, and and this didn't help, because what we experienced was lots of Vollstreckungsgegenklagen, sometimes 10 years, and this was really bad for our returns. So what we also tell everyone in the debt stack and the sponsors right now in every situation: remain calm, try to find a solution with all stakeholders, and even let the sponsor survive. Give him an opportunity at the end of the day to earn an exit fee or whatever. Don't destroy his reputation. And so in this way, and if this goes fast, this transaction, everyone can make money and receive his returns.
And that picks up what you were saying, Norbert, in essence, that there's a different approach this time around.
Yeah, absolutely. I just can't agree more. And I think, I mean, for example, what Ennis said, I totally can also agree on this, because we have, of course, have been financing a lot, in particular in the project finance sector, with mezzanine partners. And what we see here is, and this is again, we discussed it earlier, with the skill set of some project developers. I mean, of course, they are professionals in their own area, but in particular to restructure those things, right? It's for us also sometimes quite a positive aspect when a mezzanine lender come in and helps, because it gives us a kind of a support in the understanding of what is needed. Yeah? And in that regard, again, as long as it will continue that way, I'm quite optimistic that we can cope with that.
Okay, good. I'm going to come to project finance and development financing in a minute. Not an official way of doing it, but by a show of hands, do we expect interest rates to still continue rising? We won't go through all of the jurisdictions. Let's go with the ECB. Do we expect there to be further rises by the ECB? Okay. There's some nodding instead of putting hands up, so I'm taking those into account. That's about 3/4, I think, probably. We're expecting that.
So just on that,
Yeah.
during yesterday's NPL forum was the common understanding. Everyone is expecting ECB to increase in June and July by 25 basis points, respectively. But then that's the end of the story.
And then that's the end of the story.
Yeah, that's what everyone expects and hopes for.
And we're expecting at least one more rise, certainly in the UK as well, before it stabilises. Do we think then it's going to stabilise or go down? I know it's all slightly crystal ball gazing. Will it remain where it is? Is this a new normal to a certain extent? Does anybody, because obviously we got used to rates being significantly lower, and a lot of plans and strategies were based around those.
I mean, it's good. Maybe I can just give another story about this, because we've been approached by some of our clients who are asking us specifically for financings with a term of 2 years. Not all of them, of course, but quite a few, and that reflects a bit of let's call it hope that we have a different interest scenario in 2 years' time. And again, I guess no one of us can predict that, but I just realized that when you read newspapers, when you see the news or so, it is always that EZB makes it pretty clear that we have to get rid of this high inflation. And I guess no one was expecting that inflation went up that high. I have to say, I'm surprised that it's still at that level, and also core inflation. Yeah. So I wouldn't really bet on that. I would really bet that, I'm with you, I'm expecting that it will get a bit higher in the middle of this year. But when interest rates are still then there at a higher level, I guess EZB has to go in again. And that's one point. And the second point, I guess we talked about that an hour later around here beforehand. And I guess Anders mentioned it. Even if it's going down then, we will not go back to the levels where we were. And when we have a look at the past years, we had that many business models of specific investors purely based on 0 or 1% interest rate model. They will face a different market, even if we have the new normal, right? And in that regard, I guess we will see some players not able to continue with what they started, and maybe some other professionals who can cope with it.
And you already see that, because, on Tuesday, the 12 months Euribor was at 3.9, right? And we have margin levels now at 3.575, I saw already. And if you look for a follow-on financing, and 1/3 of German real estate financing is due this year or next year, this is a real hit for the sponsors, and something has to happen there.
And in terms of there's been discussion around a funding gap for some time, but that's becoming clearer and clearer, I think, in terms of, the higher the interest rate goes up, the more clear that becomes, and the weight of those issues beginning to build. How do we solve that? Who's coming in? Obviously, there's your sorts of capital that may well come in. If mezz lenders are distressed, who else is going to come in? Does that mean that it's actually a big opportunity for the funds who have raised money, but have they raised money for that situation? So who are we expecting to ride into the market and fill that funding gap?
I'll be quick. Definitely investors like us. I mean, I think there's a ton of capital on the sidelines waiting for these situations. I think there's a bit of a stalemate at the moment, as we alluded to earlier, but I think the amount of capital looking for high returns is certainly not lacking. But as I said, I think the mezzanine lenders are already showing their faces. I mean, they're coming in to help the banks. I think investors like us, like if you look at the Apollos, Oak Trees, the large private equity firms, they are focused on raising debt funds, and I think for the next 18 months, that's where the real kind of high octane activities going to be. Interestingly, what we're also seeing is a big demand for pref equity. Reason being, a lot of lenders were noticing banks not wanting to give security to guys like us coming in, partly because the situation's complex, partly because they just don't want to grant second liens, negotiate intercreditors. They said, you sort it out, not my problem. And two, I think we're seeing investors show up for this type of product.
And what I discussed earlier is, again, history repeats itself. The German institutional investors will missing out. When you ask about who's entering the party, it's again the Americans, the UK funds, Asian investors, and the Germans are just reluctant to do anything. And it's like in the early 2000s, they will enter the market when it's too late.
I can absolutely echo that from the experience of the last few months. So those situations which were solved, where we got an exit or the senior lenders got an exit, it were chaps like you who went in and provided the funds. This is on the one side, of course, a positive sign for the fund market. On the other side, I agree. Where are the German banks and where are their helping hands sometimes? Yeah? So in certain situations where we are negotiating on the bank side, it is sometimes interesting to see, and that's probably also because we had no crisis for the last 10 years, and there are many players also in the workout and restructuring departments of the banks probably new to the market. So using restructuring tools where the bank also has to go into probably a risk position is something, and also a rewards position, if it turns out to be good, is something what I would expect. Also from a bank which is, well, in particular from a market where you can say they have, they were on the side of many borrowers, also in situations of low interest rates and good valuations. And if it is a so-called house bank in particular, I'm sometimes really concerned how easy things can be exited and quickly exited by colleagues of yours. Yeah? So just going out in a way sometimes without haircut, with probably even getting a Besserungsschein or something like that. These are the structures they're thinking of. And currently, the only funds coming from funds, I can see this.
Speak up a bit for the banks here.
Yes. Yeah, that's your role, Norbert. Yeah,
exactly.
Take it on. Take it on.
No, I take the message here. No, I mean, what I just want to add is, of course, I mean, I can't disagree entirely. And I guess I gave a bit of a background with the story I mentioned with a long-time growing loan book for many banks, you know. And again, the point is really that you have to see the fact that for many banks the usual prepayment rates are vanished. You know, everyone is keeping where they can and where they can get their debt, and this is of course limiting our new business opportunities. But another point maybe is even more important. We discussed these kind of relatively tough business models of so many investors, you know, based purely on a kind of zero interest rate. For us as a bank, it is most important to see that that the investor can pay us back, you know, can pay interest rates. when you see the debt service ratios, I mean, just to give you a flavor, over the years before the crisis, we started maybe accepting debt service ratios of 6%, then 5.5%, then sometimes 5%, then hefty discussions about prime assets, and we said, okay, come on, maybe they could start lower than 5% debt service, and it ended up at some very, very strange discussions sometimes, but we agreed to that as a bank, as a senior lender. Look at the situation right now. Debt service below 6% is just not possible anymore. It just doesn't work from start. In some areas, we have to start with even 7%, or at least at the exit, we need some 7 to 8% debt service. And this is just not possible for many investors. And in that regard, this is not the kind of, the bad bankers. It's just purely mathematics that we have to say no to that point. And I think in this time, we have to wait a bit again, that we kind of separate those who can cope with higher interest rates and can handle that, have more equity to bring in, and then we can also support again. Right?
And to admit, of course, the regulatory environment and the developments over the last 10 years also not helped, or have not helped the banks either. So to get free equity for new lending, of course, yeah. We have to admit all of that. Nevertheless, some more creativity sometimes in certain situations by the senior banks, European banks, not only the German banks, would be fantastic. So UK banks very often are much more relaxed, convenient in a way and creative for solutions. In particular in these complex situations, where you say, okay, that's a risky position you're taking, but it may help the whole structure to survive. Because, and this is something what we haven't touched on, in Germany, of course, the insolvency regime is one of the issues other jurisdictions in Europe do not face in the sense. Yeah? So you are working in a restructuring always against the going concern prognosis, Fortführungsprognose, which is an issue. Yeah? So which can be an issue, which can be solved, but it's always a very hard issue that you have a borrower who is always on the brink of insolvency and has to file for it. And if you have a managing director who's not really a relaxed person, you always have the issue that you're working against a very, very hard insolvency situation, and you have to solve that at a certain point in time. You need to provide comfort.
It might be good, Anders, just to get a perspective, because you're a very popular man, Anders. Look at that. Because you're obviously looking at both Germany, but also based out of the UK, looking at the UK, Nordics, I think, as well. So I guess what's your take on some of those differences between the markets that you're seeing?
Well, Mike's absolutely right, and I know you've worked in both markets, but in the UK you have enormous contractual rights as a lender, which serves as a very big stick you just don't have in Germany. Being able to appoint a receiver in 24 hours is a huge advantage from a creditor perspective. So we see, I think that's partly the reason why German banks are more loath to pull the plug on sponsors. There's cultural reasons too, there's other reasons, but the enforcement regime is more difficult. It takes more time to enforce, and it's just more complex. We see some of the structures, name the percentage of structures in Germany that use Luxcos somewhere up the chain. You just create additional complexity there that investors need to be very, very mindful of.
Where exactly is the COMI, so the center of main interest of you have Lux structures all over the place in Germany, and if a managing director is calling you, so a Lux director is calling you and saying, so I have to follow the Lux rules, and we do not face any insolvency issues, that's the first moment when I think he has to wake up. Yeah? If there is a Lux Propco which has its building here, or property here in Germany, the likelihood is rather high that the COMI is the center of main interest from an insolvency perspective is in Germany. And that does mean that if we are in Germany filing for insolvency of a creditor, for example, files for insolvency, then it may be facing issues like a normal German managing director of a GmbH. Yeah? And these issues are sometimes surprising for in particular the sponsors. Yeah.
Okay, good. I wanted to broaden it a little, just taking it from a borrower's perspective for a moment, just to have a look at, what's in the market, what's not in the market. is project financing completely gone? Development finance. You mentioned there also office. We're increasingly getting comments about retail at the moment in a positive light, having had sort of 10 years of negative comments about retail from the investment management side. So I guess what is, can you get money for everything if you need it? And how are you viewing the sectors as well would be interesting.
I'll take this one very quickly. I agree on retail. As a firm, we've actually invested over $1 billion in the retail sector over the last 2 years, which is, potentially, taking a contrarian view, but we're starting to see a lot of green shoots in that sector, particularly in the UK, where a lot of the pain has been taken, both from an investment and occupational perspective. But I think the theme and almost an elephant in the room is the office sector at the moment. If you think about the European real estate market, say roughly 30% of the value is currently in the office sector. On our numbers, and not to scaremonger, but if you take the typical B office building, whether that be London, Frankfurt, or a European capital, and you look to convert that building to meet the ESG requirements over the next 10 years, just taking London as an example, by 2030, we're going to have a lot more stringent requirements. On our numbers, in order to take a B office to call it an A office to meet those ESG credentials and not even be at the top of those credentials, values need to fall between 50 and 60%. Obviously, that's going to vary building to building, but across the board, that's our view on the numbers. You look where buildings have transacted or where the public markets are implying, and there's been nowhere near that much value destruction. So our house view is that there needs to be quite a bit more pain to come, and I think that's just going to be a more persistent theme at panels like this.
Yeah, and it's interesting because it comes on top of the other things that we've been talking about, and that regulation is going to tighten as it moves ahead. You're already seeing, we were discussing ESG stranded assets and developments yesterday here. Another session on that and transformation and how practical some of those things are tomorrow morning in London as well. That is also, if you're taking a longer term view, quite a difficult one to tackle, Norbert, I think.
Yeah, absolutely. I would like just to add on what Anna said, totally agree. What we don't have to forget is, just said, is that next to this current interest rate inflation situation that we have seen almost years before this development coming, right? That we have the impact of home working or mobile working on office. Again, I would agree. For Berlin Hub, we've been concentrating almost always on core assets in core places, let's say. Of course, we have also a few maybe at a different level, B-ish location or B-ish character of the asset. And again, we have these topics. Just want to underline what Anna said. And in that regard, I think we can't say there is no financing for office. There is financing for office, but for the right ones. And in my view, typical for such crisis is that let's say the split, the gap where you can get what you need from an investor basis, still there, but the gap is rather big where we have to say no chance to get debt on these particular assets you just described, right? Not from a usual source, let's say. And that is definitely toxic. And what I see is in regard to office is, we discussed it as well beforehand, is that we've seen this different handling in the US and let's say Anglo-Saxon way of handling those things. And when we come back to Europe, and in particular to the German market, we always try to wait a bit and wait and see, and maybe something happens what we can't predict. And I think in that regard, quite a few players are a bit nervous what's going on the office sector. And we have to admit, the part or the proportion of office lending in the German lending portfolios is big. Yeah, this is essential. We can't ignore that. Coming maybe back a bit to the other asset classes, I think on the logistics sector, again as well, some winners, in particular on newer logistic assets, ESG conform. We can definitely provide here financings. Again, there we have to see what kind of logistics we are talking about. A lot of sub-assets, and maybe also again in locations where we again have to be a bit careful. But I would say this is still one of the better asset classes. Of course, residential, even if we have to see here as well a split between, for example, older portfolios in particular areas in Germany, for example, where you have to put in a lot of money to make them a little bit more greener than they are right now. So still some topics, and in my view, here retail, Anders mentioned it. I guess almost, at least for the banks, I can say that we've been rather, careful on this many years now. And we still, for example, on Berlin Hub side, we still finance retail. We still finance here and there a shopping center. But this is really one then, where you have the number one shopping center in an A city really showing its performance. If not, it will be tricky.
So I absolutely agree with what you said. And just looking out of the window, I see a few buildings who need refurbishment for ESG. And right now what we see in refinancings is that cash is king. So the sponsor who has cash and who can... I saw term sheets where the sponsor is asked to provide escrow or security or cash on an escrow account for 6 to 9 months interest service for the bank. If you have this, if you are strong, then you can also get a traditional loan for a refurbishment of one of those buildings. If not, you need some investors like Anders who come in and help you to as an operating partner to refurbish and build up that property.
And what about some of the other areas, because you're seeing an increasing focus on areas like, operational real estate, healthcare, senior living, but also data centers, self-storage, those kinds of more, more niche areas.
You just can, I can just probably, what is on my desk currently, so I'm just going through it. We have 2 hospitals. Which is probably a significant issue anyway. Everyone can read it in the papers. So this is a special property financing who is able to do this probably over the next few years. This is in years. We're talking about years. There may be opportunities for people like you if the relevant know-how, because the really special assets is built up. Retail, of course, still retail. I remembered when you discussed that. We had a site visit 5 years ago. You remember that in a B area, unbelievable. These type of retail buildings, shopping malls, which are, I think, they had their best times a long time ago, and these are the things which we are seeing on our desk from 50 to 350 million. You can see them all over in Germany, and every German knows these things. What we are also having is, interestingly, also because of ESG issues, special properties for automotive. We have 3 currently. Well, these are not large things, but properties which need to be refurbished, have to be financed by special financing in order to get the whole production on an ESG level, and to be ESG compliant for the whole company, which we are currently seeing puts really problems even to a corporate trying to find financing for their buildings. All across the board we can see normal office landing or mixed use. We have the shopping center below, or a shopping below, and you have shops below, and you have also mixed use living areas or offices therein. That's what we see. Developments, of course. We have not yet talked about that, but these are the things we are facing the most things currently.
Okay, good. I just wanted to pick up if there are any questions, because you should have one, Tanner. You've got one as well. Okay, let's take it. Who's got questions, and then I'll. So if one. Any others? Okay, great. Let's start.
Thanks, Regis. My name is Tanner, and I'm joining from Realtor. We are a specialized investment manager on supply chain oriented logistics. So my question is related to sub-asset class you mentioned, Norbert. So we are in the US have been investing in industrial outdoor storage properties for more than 30 years. So now we are bringing our expertise to Europe. We have started assembling a portfolio right now. We are around like 250 million euros in these properties in Netherlands, in the UK, in France as well. So my question is, how is the interest from lenders or from investors on investing in these assets? Because these asset classes became institutional in the US in the past 10 years, 15 years, and it's becoming more and more popular, and we see that in Europe as well. So I wondering your thoughts about this.
May I ask you a question? You're asking about financings for portfolios like that, not for single assets, right?
Yeah, portfolios like that.
Yeah, I mean, again, this is for us at Berlin Hip. We look at these markets you mentioned, right? Even if I have to say that maybe we are not really the first address, let's say, so to say, when it comes to cross-border. Yeah, because in that regard, there are other players in the market who are a bit more active in that area. But I would say overall there is interest in looking at this, and yeah, and in that regard, go forward and get in touch with us. I think there's no, again, I wouldn't say at the minute that there's something where we would say we would not look at that because of the current situation. It's more that really it depends then on how is the fit for our financing portfolio, right?
Great. Marcus.
One question to the panel. We're talking a lot about senior financing, mezzanine. Looking at the corporate debt market, which looks like that in 25, 26, we see a wall of refinancings coming from the bond market. How do you see this in context of today's situation? Because now it's not easy, but it's not getting better.
I'm happy to pick up on that quickly.
Yeah.
I think that's a great question. If you look at the corporate debt market in the real estate sector in Europe, it's about 250 billion euros, which is somewhere between 3 and 5 times what it was 4 or 5 years ago. So this market has just ballooned in size. And it's amazing that a lot of the public companies and some private companies have grown so massively off the back of this market alone. So if you look at Aroundtown as the biggest example in Germany, they were buying assets 6-7% cap rates with 1.5% debt. That was a great business for a long time, but the tide's come out on a lot of these companies, and even the higher quality companies like a Vonovia have real issues. The LTV is just too high for a public markets investor, and the only real levers they have is they can sell assets or they can raise equity. No one wants to raise equity right now because it would be heavily dilutive, and no one wants to sell assets. So it's a really interesting situation, and I think the only other lever they have is for banks to pick up slack. So that's a real question in terms of how much the banks are going to look to refinance maturities in this market, because over the next 2-3 years, there is an enormous wall of these debt maturities. And an interesting point, we've seen this most acutely in the Nordics, the market that relied most heavily on this public debt, the likes of Balder, SBB, Heimstaden. I think a lot of investors are looking to these companies to see what they're going to do, because that's really going to set the tone on things like valuation, on equity raises, and that's expected to proliferate into the private markets.
And when I maybe just add, it already started, right? Because we have a number of these addresses, Anders just mentioned, and they haven't talked to us as a Pfandbrief bank for a long time, because they just said, sorry guys, we can't get together with you. You're just by far too expensive for your syndicated loan. And that was a matter of fact for many years. And I would say it started maybe a year ago, that they started again to say, maybe you can give us an offer. And here and there we already financed with a classical syndicated loan a part of their portfolio. And I think this is the beginning of what we will see. And I agree with you that it's a very interesting point. And I guess at the moment it's too far away. We have other issues at the moment, but there will come a time when we have to discuss it. How we can, let's say, observe and how how we can make sure that there's no gap when these terms are for refinancing, right?
Yeah, I would just add that it has already begun. So if you're looking for the refinancing requirements of corporate bonds in the real estate market, I think looking into the names which are currently on the market, the problems start with the bonds. Yeah, and it has already started, and I agree that will be a wave. If it is not solved in a certain extent, it will be a wave.
Okay, good. Any other questions? Yes.
Can I just jump on this train and ask a question as a continuation of the previous one? How do you evaluate the interest of the investors generally in the real estate market in the coming years? Because as we see the deteriorating reputation of real estate investments and the coming problems with the corporate bonds and so on, how do you estimate the competition between different products as compared to real estate investments, like state bonds and stuff like that?
Sure. Actually, what we did last year when we saw the world change quickly with the spike in rates, we actually shifted almost all of our focus to the public markets and invested in some of these debt structures because we saw good companies with debt that had credit spreads up to 8-9%. And if you look at the underlying properties, obviously you have to be careful in selection. We thought that's a great deal. What's happening here? Why can I buy a Vonovia bond at a high single digit when the value of those assets is supposedly 3-4%? And I think there's a lot of complexities, but part of the answer is that the real money community just does not want to touch real estate right now. They say, hey, they call their trading desk, what have you got for me? Anything but real estate. Because they don't have the wherewithal to figure out the underlying value. And they see certain special situations like the Adlers of the world, a couple of the Nordic situations, and they say, we just do not have the time to figure this out. So there's a real dislocation. I think that's a great question because the sentiment's turned very quickly away from real estate in the public markets.
But what is your estimation for the development of this trend? Where do you see it in like 1, 2, 3, 4 years from now?
I think there's got to be quite a bit of pain that needs to flush through the system before the market normalizes, and it will eventually normalize. If you look at some of the really big names in the market, they need to delever, they need to sort out the maturities, and I think there will be a handful of true restructurings in the public sector.
There will be bankruptcies, no doubt.
I'll pass it to Mike, but there will be insolvencies, and after that pain's had, then I think we're going to see, okay, who's left standing, and I think investors are going to be a lot more cautious, but it will probably be 3-4 years until this market normalizes.
Question. We talked a lot about the downside and all the funding costs. What about the other side in terms of how you view on potential cash flow inflation? I'm thinking especially around large residential portfolios when there are perhaps inbuilt inflation features or perhaps leases with inflation features in them. And how cautiously do you assess these?
This is the big counterbalance, and the bulls say, well, the German resi markets have moved out so significantly, but then investors say, well, I'm not selling at a deep discount. The public markets are implying a 20-25% discount to JV for German resi. You get half the camp that says that's not enough, half the camp that says that's too much because I get all of this inflation protection. I think it varies asset class to asset class. When you take German resi as a prime example, yes, there's a severe shortage in housing. Yes, there's inflation linkage. But at the same time, you have a pretty stringent regulatory framework that inhibits that inflation to pass through to the landlord. So you got to be really careful on that. In some other sectors, that's been a bit better. So in the logistics sector, you've seen that inflation come through, favorable supply-demand dynamics. Landlords have been able to pass through inflation to the tenants. But my personal view in a lot of these situations, that's gone a bit too far, and you're actually seeing a teetering off of rental growth. So I think it's a very difficult balance, but you got to be careful, and it varies greatly between different asset classes.
What we see in commercial real estate, not residential, I mean, your typical hedge against inflation is an index clause in your commercial lease agreement. But there we see lots of tenants negotiating with the landlords to not increase or give them a break period or something like that. So that's also a problem in commercial real estate.
Right, let's have a last one. And I'm going to try and be... We've talked a lot about the upcoming pain. So if you've got an optimistic view, what would that be? Where's the optimism? What's a positive take on it? Whether that's that, it's going to drive a lot more. So for example, it may well mean that some of the assets that now need redoing, it makes sense to go ahead with full sustainability earlier than maybe it might have happened before. Would be my sort of positive take on some of that. Is that sustainability, for example, and the financing for that will be a very big part of what goes on. That's mine. But has anybody got any positive takes?
My one very quick positive take is that now, more than ever, you have to be an intelligent investor. You have to choose assets very carefully. You have to choose the sectors very carefully. You need to set up your structures with great care. And it's not a function of, lowering costs of capital over a long period of time. I think now we're entering a more normalized environment in many respects, where being a skilled investor, choosing assets, choosing partners carefully is paramount. And I think that was lost over the last couple of years to some extent.
My positive aspect is that I mentioned it at the beginning. There are a lot of professional partners in the market. There is kind of a sentiment that people are calm, people are willing to get solutions. This is all good. It will take some time. We have to be realistic. So don't think. I mean, I don't think that we will see a bigger improvement by end of this year. Yeah, but if you are realistic, if you work together, and as just mentioned, work together with guys who are understanding the markets and know what we have to do right now, then this is something which we can, let's say, overcome. And again, I have to speak up for the banks maybe. Sometimes I've been asked, do you can compare this situation with, financial crisis time or whatsoever? I would definitely say no, because we are much better prepared. We had to, fair to say, but we are much better prepared. And I think in that regard, I can't see here something which is an explosion like we had 2008 or so.
Yeah, I can just echo that. So the professional way handling this crisis, let's call it crisis, is really promising. On the other one, I said that already, a bit more creativity in some areas would be great. And if we're talking about a very positive sign, just last week, clients of us signed a so-called New Green Deal. What is that? They formed a JV going into distressed situations and trying to acquire the properties to rebuild them and to make them, of course, ESG compliant within 5 years. Something like that, as you mentioned that, something like that is rather a nice thing and makes me optimistic that there is also a market which tries then to, of course, to use the opportunities which this market is offering. Yeah.
Yeah, I absolutely agree. Although it's a poly-crisis now, real estate will survive, and what we will see is that substance is hip again. So we will see investors and real estate owners who not just buy something, wait a bit and buy it for a higher price like they did in the past 10 years, but now you need asset management capabilities. You need a team with brains and which works on the deal, and those guys will also receive lending from the banks, and then it will be a cleared out situation in the market.
Okay, great. Thanks very much. Thank you for all your questions as well. Thanks for sharing your insights. If you've been watching this on demand, thank you very much for watching. And because we are all back in person, we can all give ourselves some applause for being here. So thank you to everybody and thank you to the speakers.